now, new official figures show that wage increases have hit a record level. Here's what the numbers from the Office for National Statistics say. This graph shows regular pay going back to 2001, when the ONS started measuring in this way. It shows wages, not including bonuses. Now, looking at the blue line, you can see that after a long period of relatively stable growth, the annual rate of increase has soared and now stands at a record 7.8%. But employees aren't feeling that benefit in their pocket because of inflation, and we get new figures for that tomorrow. But this yellow line shows what happens when the ONS adjusts regular pay to factor in the rising price of goods, including housing. Tiny growth of just 0.1% this year, after almost 2 years of decline. Now, one of the drivers of pay growth has been the shortage of skilled labour, but there are signs that demand for new workers could be falling. The ONS estimates that the number of vacancies fell, the longest sustained fall in vacancies since after the 2008-09 financial crash, although the number of positions vacant remains very high by historic standards. And unemployment in the UK is also increasing, according to today's figures. This graph shows the unemployment rate over the last 5 years. Now, it hit 5% during the worst days of the pandemic. It had dropped back to pre-pandemic levels, but today's stats show it rose in the latest quarter to 4.2%. Well, the Bank of England will be poring over all of this data because higher wages risk further fueling inflation, and that could force the bank to raise interest rates once again. Well, to discuss this, I'm now joined by the economist Mohammed El-Erian, formerly the CEO of the giant bond traders PIMCO and now president of Queen's College, Cambridge. Mohammed El-Erian, when you consider all of that data, is it now a certainty in your view that the bank is going to have to increase interest rates once again?
Yes, it is. And the only question is, will it increase it by 1/4 percentage points or 0.5 percentage points? I think it will be 1/4 percentage point, but the market thinks there's about a 30% probability it could be 0.5 percentage point.
And perhaps more than one increase over the next few weeks and months.
Correct. So if you look at market pricing, which has changed significantly on account of the data you just presented, the markets now expect that the Bank of England's base rate, which is now at 5.25%, could go as high as 6%. That will reverse the last week's decline in mortgage rates and put more pressure on households, of course.
And I'll come back to that, but will these interest rate rises, in your view, make a real difference to inflation, a tangible difference?
That is the big dilemma, is that when inflation moves from the goods sector to services and then to wages, monetary policy cannot get to it as effectively. Put another way, wages are not as sensitive to interest rate hikes as the goods sector is. So when you see inflation embedded in the wage sector, it means that interest rates will have to go higher and stay there longer than they would have been otherwise.
And I suppose, the bank faced a lot of criticism for not moving swiftly enough to raise interest rates in the beginning. But is there now a risk that they go too far and prompt a recession? Or is that required in your view?
It's not required, but it's certainly a risk. And the reason why it's a risk is that we're focusing all our attention on the Bank of England. We're not talking enough on what the government can do to also help in this inflation fight. So if the Bank of England is the only game in town, is the only policymaker working hard to lower inflation, then they will tip the economy into recession. They need help from the government.
Well, what can and should the government do, in your view? And is there a real possibility that people will start feeling better off in time for an election expected next year, or not?
So what the government should do is help on the supply side. Even if you look at today's numbers, there's a very large portion of our society that is inactive. People who are sick, people who are outside the labor market. If they came in, that would enhance supply. There's other steps that the government should take and can take to enhance supply. If it doesn't, then the only way to bring inflation down is through a recession. And there's a risk that it goes into the next election with the average person having been hit first by prices going up much higher than their wages, and then second by income insecurity.
So what are those other measures that you thought the government should take to enhance supply that you just alluded to there?
It basically addresses a long-term problem we've had, which is productivity. Our productivity has lagged. Our responsiveness to higher prices has lagged on the supply side, which means that when you get inflation, you end up crushing demand rather than solving it through the supply side. Now, there's lots of things they can do. Admittedly, it doesn't have an immediate effect, but if the market sees that the supply side is getting more flexible, then it will not push interest rate as high as it would otherwise.
And in your view, these problems that we've been talking about, is there a kind of particularly British aspect to all of this? And if so, why?
There's three particular British aspects, and that's why our inflation rate is much higher than other G7 economies. One is that we have what's called real wage resistance. We tend to resist an erosion in our real purchasing power much more than elsewhere. Two, we have redefined our external relations in such a way as to make our supply chains less flexible. So
You mean Brexit there?
The goods coming from the rest of the world are more costly than they would have been otherwise, and that's because of Brexit. And then third, we've had a long-term productivity problem. And that's why the Bank of England's challenge is considerably higher than that of the Federal Reserve in the US or the European Central Bank.
Fascinating stuff. Mohamed El-Erian, thank you very much for joining us.